I want you to imagine two scenarios. In scenario number one, a client is sitting in front of you and your supervisor is here watching you. Okay. So in this scenario, I assume you would do your best to satisfy the client, to do everything smoothly and follow the laws and have the best customer service. And in scenario number two, your supervisor is not here. Nobody's watching you. You and your client. Do you still perform exactly like scenario one, or your way of service to the customer will change? I mean, would you still recommend the best products out there to your client, or no? You would just look at your own pocket and recommend investments that benefit you than clients. In this lecture, we're going to talk about ethics. Ethics occur when nobody's watching you, okay? You, as a mutual fund dealing representative, you need to act always, no matter if somebody's watching you or no, always in the favor of your client. In this lecture, we're going to dive deeper into ethics and why this factor is very, very, very important in mutual fund industry. Let's get it done. Ethics. What's ethics? Ethics is about doing the right thing even when no one is watching. It's more than just following laws and rules. It's about making decisions based on honesty, fairness, and integrity. Let's elaborate on ethics with a scenario or example. Let's say you are a mutual fund dealing rep and you have a client named Mr. Smith. Mr. Smith wants to invest in a mutual fund. He has some money, he wants to invest in a mutual fund. Now, you have two options. There are two options actually. Two funds to invest Mr. Smith's money on it. Both funds match the risk profile of your client. Okay. Fund B has higher fees for your client, but more commission for you. In this situation, let's say nobody is watching you and nobody will notice the high fees. Okay. Based on rules, you have to recommend Fund A because of the lower fees for Mr. Smith. But let's say in this situation, if you offer Fund B, nobody will notice, okay? Nobody will come to you and say, hey, why did you offer Fund B? Now, what do? Do you prioritize your earnings, your commissions, or you act in the favor of Mr. Smith? This is exactly where ethics comes in, okay? Now, let's recap on some rules and laws that we already know from previous chapter. What are the key rules and laws? Number one, know your client. We will get into details of know your client or KYC in future lectures and chapters, so don't worry, just have an idea, okay? When the client comes in, we know that they need to fill out the new application form and know your client form. In some firms, these two forms are one form, okay, just integrated together. So we need to gather client information to recommend suitable investment. This is law, okay? This is not about ethics. This is the rule that you need to obey. Also, there are suitability obligation, okay? We need to ensure that the products, the investment that we offer match the client's risk profile and financial goals and objectives. Then we have anti-money laundering, AML laws. Okay, we need to report suspicious financial activities to FinTrack, to our compliance department. Then the compliance department will contact the FinTrack. I think you remember them from previous lectures and chapters. Okay. And then we have disclosure requirements. What does it mean? It means that we or you as a mutual fund sales rep, you need to provide all relevant details on fees, risks, and fund performance, okay? And we know that breaking any of these rules can lead to fines or even license suspensions and criminal charges. So, we talked about these rules, and we will definitely talk more in details in future lectures. Now, let's get to our situation in this lecture. I mean, when nobody is watching. When nobody is watching, ethics apply. The concept of ethics, okay? This ethics have some core principles, okay? Let's get to details of core ethical principles for mutual fund representatives like you. Core number one or concept number one is fiduciary duty. What does it mean? It means you, as a mutual funds sales rep, you need to always act in the best interest of clients, even if it means lower commissions. Okay. Fiduciary duty in a holistic view, fiduciary duty means doing all the research and investigation and your studies to find the best advice to your client based on client's profile. Okay. Now, in ethical matter, you need to always act in the best interest of client. Okay. The next core concept about ethics is transparency and honesty. You have to clearly explain fees, risks, and potential returns without misleading information. Let's say Mr. Smith doesn't have any idea about the fees. There are lots of hidden fees. We know that we have faced those hidden fees. Okay. You have to be transparent and honest and say, hey, Mr. Smith, I mean, these are the fees, these are the hidden fees. And at the end of the day, you will get this much return, okay, after deducting all of these fees. And there are these risks with this investment. You have your client, in this case, Mr. Smith, need to know all the risks about the investment because at the end of the day, he's putting his money, all of his hard earned savings into something, into a investment product. He has to have an idea of, okay, what's that product? Like everything about that product, you have to provide those information. So transparency and honesty is another core principle of ethics. The third one is fairness and suitability. These are all like overlapping, okay? What's fairness and suitability? We need to recommend products that match a client's financial goals, okay, and risk tolerance and needs. If our client is, let's say, he's young, okay, 30 years old, and he wants to buy, I don't know, house, like a condo in 5 years. We cannot just put that money in a money market fund. We will get into details of money markets. So if you're not getting the point right now, no worries at all. Okay. Money market funds are a type of mutual fund that has the lowest return, but the lowest risk. Okay. But a young individual who's in IT and who's earning, I don't know, let's say 100K, and who's not a risk averse person has a high risk profile. So money market does not match your client, your young client. You have to propose more growth fund. We will get into different types of funds. Okay. This is just an example. Growth fund is better. So we have to make sure that our product that we are offering to our client is suitable for the based on the client's risk profile and needs. Okay. The next core principle is confidentiality. What does it mean? It means we need to protect client information and never use insider knowledge for personal gain. Remember Pipeda? those apply here. And insider knowledge means, I mean, we will get into details. I don't want to like explain here to make you more confused here. And the last core principle of ethics is compliance and integrity. Whenever throughout the course you hear the word compliance, it means following laws and regulations. Okay? Following laws and regulation means compliance. This core principle says that we as a mutual fund sales rep, we need to follow laws and regulations and company policies at all times under every situation, even when nobody's watching. This is the most important part. When somebody is watching you, of course you will follow rules and laws. The hard part is you have to follow them when nobody's watching you, when you're alone. Okay. Great. Now let's get to the a test called ethical test. When you're alone, there are some situations that you will be confused and you will be like, okay, what approach is better now? Okay, I understand nobody's watching me, but which way is better? Which option is better? I want to act in the best interest of my client, but I don't know which one is better. This is when ethical test comes in. What does ethical test means? Ethical test is used before making a decision. Okay? When you want to offer any advice or any recommendation to your client, ask these questions. Is it legal? Is this recommendation or whatever I'm offering to my client, is this legal? Is this fair for the client? Or would I feel comfortable if this was on the news? Like if you offer something to Mr. Smith, and let's say whatever you offer to Mr. Smith will be on the breaking news line. Will you be proud of that decision? There are lots of tests. By tests, I mean there are lots of questions that you need to ask. You can ask like, will I do this recommendation to my partner or to my close friend or my family? Will I do that? These are ethical tests, okay? You need to do and apply these tests. Ask these questions from yourself before making a decision to your client. And remember, when you're unsure, ask your supervisor or compliance officer. We said that in every bank there is a compliance department. Go ask them or your manager. You're unsure. That happens sometimes, okay? Managers are for these uncertainty times. They need to support you through this. Now, let's wrap up ethics, okay? We talked a lot about ethics. What are key takeaways here? In finance, ethics is crucial because people trust financial professionals with their money. Okay? If advisors act dishonestly, it can harm clients and damage the entire industry. What are the examples of ethical conduct? Honesty. We said that an investment advisor fully explains risks and fees before recommending an investment. Fairness. We need to treat all clients equally, regardless of their wealth. You can't be good with like high net worth client and bad with low net worth client. No, this is not the way. And confidentiality. We need to keep clients' information private. But what are the examples of unethical conduct? Misleading clients, okay? What does it mean? It means making false claims about an investment. You can't say, hey, Mr. Smith, if you invest your money in this stock or in this mutual fund, you will earn 20% annually. No, this is misleading. What if the market crashes? What do you want to do then? Mr. Smith can complain and your license even there will definitely be some fines, but your license will be suspended. You shouldn't provide misleading information, conflicts of interest, okay? We cannot recommend an investment because it benefits the ourselves more than the client. And the last example of unethical conduct is not following regulations, okay? For example, if you are become a mutual fund sales rep, you cannot just sell individual securities or stocks because you're not registered there. Okay, great. This was about ethics, and sorry that it was a long lecture. I had to cover everything. Go crush the quiz, and I'll see you in the next lecture. In this book, and when you get hired by a bank, you would hear one term a lot. That term is compliance. Whenever you hear the term compliance, it means following the rules and laws out there. Even we have a department in every financial institution called compliance department. That department makes sure that all the employees follow the rules. In this lecture, we're going to talk about different aspects of compliance, why it's important that you, as a future great mutual fund dealing representative, you follow the compliance, you comply with all laws and rules out there. Let's dive deeper to the term compliance. Let's get it done. Compliance. Okay, what's compliance? In the previous lecture, we said that whenever you hear the word or the term compliance, it means following the laws and regulation. So, compliance ensures that you follow the laws, act ethically, and protect your clients from financial harm. So, compliance is an umbrella, okay? You follow the rules. We have lots of rules there, and you've heard them so far, lots of them. In the previous lecture, we talked about ethics. You follow ethics also. These are all under compliance, and overally, you protect your clients from financial harm. Think of compliance like road signs. Okay, without compliance, there will be a chaos. We have a term called compliance regime. Compliance regime means all mutual fund dealers, banks, or any financial institution who sells mutual fund, okay? All mutual fund dealers must have a compliance regime. What does it mean? Compliance regime is a system of rules, policy, and supervision to follow securities law and manage risk. Now, imagine a bank here, okay? When we talk about compliance regime, we focus on three different parts in a bank. We have you as a mutual fund sales rep, we have compliance department, we have ultimate designated person. Okay, these three parts makes a system. Okay, this is called compliance regime in a bank. Now, what's your duty as a mutual fund sales rep under compliance regime? You must understand and follow your firm's policies. Compliance isn't just a department's job, okay? It's your responsibility too. I know we do have a compliance department. They oversee everyone, but compliance starts from you as a mutual funds sales rep. Okay. Now, under compliance regime, we have compliance department. We said that every mutual fund sales rep have a compliance. Sorry, every mutual fund dealer has a compliance department. Okay. The compliance department is not your enemy because some individuals who work in a banking industry think that like whenever they hear the term compliance department, they are like, oh, compliance, just no, please no. I mean, they're not your enemy. They are actually your safety net. Okay. What do they do? What do compliance department do? Let's zoom in. They monitor new accounts, trades, and transactions. They provide training to keep you updated on regulations. They help you manage risk and avoid costly mistakes. They're your friend, not your enemy. We said that in the previous lecture that if you're ever unsure about the rule, ask compliance. It's better to get guidance before making a mistake. Great. Now, in compliance department, we have a role called Chief Compliance Officer or CCO. This role is firm's compliance leader. Okay. This leader monitors and reports compliance issues to UDP. We will get to UDP, okay? And this CCO submits an annual compliance report to the board of directors. So please know the rules of CCO. They monitor and report compliance to UDP, and they submit an annual compliance report to the board of directors. This is important, okay? Keep this in mind. Now let's get to UDP, or ultimate designated person. Who's this person? Who's this handsome guy in suits? This is the CEO, or highest authority in the firm, okay? This individual, or UDP, ensures the firm follows compliance laws and promotes a culture of compliance from the top down. Okay, this is the ultimate guy. Great. We covered compliance and compliance regime and three different parties to this regime. You're doing great. And please go crush that quiz. I'll see you in the next lecture. So far, we learned about Securities Act, mutual fund legislation, MFDA rules, some national instruments. I'm not sure why these securities regulatory came up with another sets of rules called CFR and CRM. CFR is baby of CRM. This CFR is an amendments to existing rules saying, hey, your client's interest must always come first. I mean, we knew this before. I mean, we didn't need this CFR. This CFR rule is an emphasis to that, hey, make sure your client's interest comes first. But the CFR is important because we always get one question from this term on our final test. So let's learn more about CFR and what do I mean by the fact that your client's interest must come first. Let's dive deeper and get it done. CRM and CFR. Okay, what's CRM? CRM, it's both of them are about some rules and laws, okay? We had National Instruments, Securities Act, and then MFDA rules. And of course, all of these laws and rules are overlapping, like maybe 60% overlap. And this is so natural because all of them, at the end of the day, wants to protect the client. So they will have lots of overlapping. But let's get to CRM. What's CRM? So CFR, remember, keep this in mind. CFR is baby of CRM. CRM is a parent, okay? CRM is a rule that ensures that when your client invests his money, they get clear and honest information about their investment. And you as an advisor, you assess if an investment is right for your client before selling it. And rule number 3, that the clients receive regular reports so they always know where their money is going. So CRM basically includes these 3 important rules. In short, CRM makes sure that advisors like you treat the client fairly and provide transparent financial advice. I mean, we have heard all of these words in previous lectures: transparency, fairness. You see the overlapping here, okay? But I have to cover them because this is different set of rules. And compliance and ethics, these are broad words, okay? Compliance and ethics are broad words. And CRM and CFR goes under both of them. And what's the difference between CRM and CFR? We will get to definition of CFR, of course. But remember, CRM was the first version. It introduced basic rules for fairness, transparency, and investor protection. Then CFR born, okay? Born out of the CRM. CFR just updated some parts of CRM and added some statements to it to make it better. Now, think of CFR, or client focused reforms, as an upgrade to CRM. Okay, it tightens the rules to make sure that advisors must put clients' interest first. Okay, they shouldn't put the commission ahead of the client's interest. No, it doesn't work like that. Advisors like you must avoid conflicts of interest, and advisors must be fully transparent about fees and risks. So CRM and CFR are basically same. CFR is a newer version of CRM, but CRM has a broader statements about market fairness and honesty and integrity. There are 5 different sections or steps or parts in both of CRM and CFR. Let's get to step number 1, or part number 1, which is relationship disclosure information, or RDI. What's RDI? Let's say you have a client named Sarah. Again, Sarah. I can't think of any other name. When Sarah decides to open up an account with you, the first thing you must do is, we said that the first thing is filling out the new application form and then KYC form, remember? But even before that, you or at the same time, or even after that, these can happen simultaneously too. You have to hand over the relationship disclosure information, RDI. What's RDI? What's in it? RDI is a document that tells Sarah, or your client, that what services you offer, how you handle conflicts of interest, how you determine which investments are suitable for her, what fees she will pay. Okay. So basically, it covers the nature of relationship between you as a mutual fund sales rep and your client. That's why it is called relationship disclosure information. But why is this RDI important? Because Sarah, or your client, deserves full transparency before she makes any decisions. And if you fail to provide the RDI, if you forget, or if you don't do it on purpose, you are not meeting compliance standards, and there will be fines, of course, or even license suspension. But the problem, this is not mentioned in the textbook. This is my experience. The problem with RDI is like 1,000 pages. Who reads that pages? Nobody. It's like when you are buying an insurance, they send a booklet which has 100 pages describing every terms in it, everything. I mean, nobody reads it. And I think this whole 100 pages, it's like terms and conditions of all websites. Nobody reads it, okay? This concept will change shortly, I'm sure about it, because this new generation won't tolerate that. Okay, they need a concise uh, information, like just in one page, maybe. Okay, I talked a lot about it. Sorry. One important point about RDI. We need to document things, okay? So before your client leaves, you must keep evidence that she or he received and understood the RDI. That's important, okay? There are two scenarios. If the RDI is part of the new client application form or NCAF, her signature is enough. There will be just one signature and it confirms that she has understood and received the RDI. But if the RDI is a separate document, you should get a signed client acknowledgement and keep notes from your discussion. This is very, very important. Let's get to step 2 or part 2 of CFR or CRM, and it is conflicts of interest. We will get into details of conflicts of interest, different types, what should we do, the options. But in general, let's say, let's get back to our scenario, okay? Let's say Sarah, which is your client, asks you that I heard some financial advisors push certain funds because they make more commission. How do I know you are recommending the best for me? Okay, Sarah is suspicious about you. What should your answer be? You will say that, hey, Sarah, under CRM, I must handle conflicts fairly and transparently. And even under CFR, I must always put your best interest first. So, CRM and CFR assure that I will I will put your interest first. Don't worry about that, Sarah. Okay, Sarah? Now, what does it mean for you as a representative? If you earn a commission for selling a certain fund, you must disclose it. Okay? You're earning commission. This is your job, but disclose it to your client and say, hey, client, when you're buying 10K in investment, this 100K, this 1% is my commission, and you have to know this. I'm disclosing it. And and if there is a conflicts of interest that cannot be managed fairly, you must avoid it altogether. Okay? We will get into this specifically in future lectures. If you recommend a fund just because you earn a higher commission, you are violating compliance rules. You shouldn't do that. Great. This is about conflicts of interest, which we will cover in details in future lectures. Let's get to suitability assessment. Suitability also will be covered in future lectures and chapters. But let's get back to our scenario. Let's say Sarah tells you that she wants to invest in an aggressive growth fund. But you review her profile, and after reviewing the her KYC form, you realize that she has low risk tolerance and she needs access to her money soon. Okay, these are all red flags. I mean, she cannot invest in the aggressive growth fund because of her profile. So, what do? Under suitability assessment of CFR, okay, or CRM, let's say under CRM, you must assess suitability before making a recommendation. So CRM is a law that makes you and makes this process mandatory for you. Okay, it's not optional. You have to assess suitability before making a recommendation. Under CFR, you must always put the client's interest first when making a suitable determination. So these are both same, almost same, with little tweaks. Now, your responsibilities, you explain the risks of aggressive funds to Sarah. Then you recommend a more suitable option based on her goals and profile. Okay? And then you have to document this conversation to ensure compliance. You have to document everything. Great. Let's get to part 4, step 4 of the CFR and CRM, which is pre-trade cost disclosure. Let's say Sarah wants to buy a mutual fund and asks, are there any hidden fees? So, under pre-trade cost disclosure of CRM and CFR, you have to, okay, before placing the trade, you have to disclose all costs to Sarah. You have to explain if there are management fees or ongoing expenses. Disclosure is a key here. Great. Let's get to the last part of the CFR and CRM. Last section, last step is reporting to clients. A few months later, Sarah wants to check how her investments are doing because she invested her money. So she wants to know what happens to that money. Is there any loss, gain? She wants to know. So under CRM, you must provide these 3 things to Sarah. And this is important, okay? Trade confirmation is the first one. What's trade confirmation? Details of any trade. When Sarah or she, your client, buys and sell investment, you have to provide the trade confirmation to her. Then account statement. Every quarter, you have to provide account statement to Sarah showing her holdings and costs. And then annual reports on charges and performance. You have to provide this also to Sarah. So these 5 sections, parts, or steps were all under CRM and CFR. And in short, in summary, CFR and CRM are on top of the rules and laws that we learned in previous lectures, okay? Keep it up and I'll see you in the next lecture. By the way, go crush the quiz. I want you to imagine 2 scenarios. Scenario number 1 is, let's say your brother comes to your bank and wants a loan. Everything is legit about your brother. I mean, he has a good job, he's making good amount of money and he's qualified to get the loan. But he applies the loan through you and you confirm it and everything is good. But do you feel like people outside, like maybe your colleagues or other clients, may think that, hey, it's not fair. Maybe Nav didn't thoroughly investigate and explored everything, every documents that his brother had. Maybe he took easy on him. This is conflicts of interest. People may think you have interest in this loan, so you didn't do your job very good. Or scenario number 2, there are 2 products. You have a client, there are 2 products. Product 1 is a good product that matches a client, but gives you a lower commission. Product B is, again, good product, matches your client, but gives you more commission. Okay? Which product would you recommend to your client? The one with a lower commission or higher commission? This, again, you have an interest in this transaction. This is conflicts of interest. You don't know what to do. I mean, after this lecture, of course, you would know, and I think you already know that you always need to act in the best interest of your client. You shouldn't think about yourself. In this lecture, let's dive deeper into concept of conflicts of interest, into different types of conflicts of interest, and how to manage when you face a conflict of interest. Let's get it done. Conflicts of interest. We talked about it, but in this lecture, we're gonna dive into details of conflicts of interest, the broad categorization, the common types and examples, and what should you do as a mutual fund sales rep when you face a conflicts of interest, and other details. So this is very important lecture. In general, in the financial world, conflicts of interest happen when an advisor's personal gain might affect the advice they give you, they give the client. There are three big or broad categorization of conflicts of interest. We have existing conflict, we have potential conflict, and we have perceived conflict. Let's define each of these with an example. Starting off with existing conflict. Existing conflict is a real conflict based on something you are currently doing. Let's elaborate with an example. You are a financial advisor recommending an investment fund to a client, but that fund pays you a big bonus for selling it. This situation creates a conflict because you might push the fund for personal gain instead of what's best for the client. So this is existing conflict. We are encountering and facing this conflict right now based on the moment, this situation, okay? The second one is potential conflict. Potential conflict, in the potential conflict, no issues appear right now, okay? But a conflict could arise later. What's the example? Let's say you're advising a client about buying a startup's stock, okay? This is a small startup. And you're considering get a job at that startup. Now, if you take the job later, it could look like you were trying to boost the stock for personal benefit because you are now employee of that startup and you have a big investor here which you directed to buy that stock. This is, potential conflict of interest. This might happen in the future. The third one is perceived conflict. What does it mean? There is no actual conflict in perceived conflict, but it appears suspicious to others. What's the example? Let's say your friend or family member applies for a loan at the bank, okay? And you approve it. Even if you followed all the rules and if the your family or friend qualify for that loan, people might think you were biased. Okay, you didn't review all the documents. You were nice to them. This is exactly the example of perceived conflict. Okay, we broadly categorized conflicts of interest into three types: existing, potential, and perceived. Now, let's get to common conflicts of interest that happens for you as a mutual fund sales rep. Number one, selling your firm's own products. What does it mean? This conflict of interest happens if your bank, if the organization, the financial institution that you work for offers its own investment funds. So that bank may push you as a mutual fund sales rep to sell their product instead of better options. Okay, let's say you work at XYZ Bank and that bank offer their own mutual funds. You might feel pressured to sell those funds instead of better ones from another company. This is exactly when selling your firm's own products leads to conflicts of interest. What's the solution here? What can you do when you face this type of common conflict of interest? You recommend what's best for the client, even if it's not your firm's product. The second common type of conflict of interest is compensation-related conflict. What does it mean? Some products pay higher commissions than others, tempting advisors like you to sell them more. Okay? Let's say product A pays you a big commission, while product B, which is a better fit for the client, pays you less. You might feel pressure to sell product A for a bigger paycheck, but you shouldn't do that. What should you do? You should always choose the product that benefits the client most, not you. Great. The third common type of conflict of interest is referral and service arrangements. What does it mean? Some firms pay referral fees for sending clients their way. Okay. For example, your firm offers a bonus if you refer clients to a specific insurance company. But that insurance company's policies might not be the best fit for your client and for everyone. This is when this type of conflict of interest arises. Okay, what's the solution? You should be transparent with your client about any referral fees. Okay, and remember, only refer them if it's truly the best option. Okay, uh, let's say your client is Mr. John. Okay, and you are referring Mr. John to an mortgage specialist, a great one. But that mortgage specialist pays you a referral fee, okay, or pays your firm a referral fee. And you know that that mortgage specialist is great at what he's doing and it's a great fit to your client. But you should be transparent. You should say to Mr. John or your client that, hey, I am getting this much referral fee and I am referring you to Mr. X. Okay. But remember that Mr. X is great at what he's doing. So be transparent when you face referral and service arrangement type of conflicts of interest. The fourth common type of conflict of interest is having another job or business. What does it mean? If you work another job or run a business, it might affect how you treat clients. So this arises another conflict of interest. Let's elaborate with an example. Let's say you are a financial advisor, but also a real estate agent. Okay. A client asks for investment advice and you push them to buy a house instead of stocks because it benefits you more. This is exactly when having another job or business type of conflict of interest arises. What's the solution here when you face this type? You should tell your firm about another job. Okay. You cannot sneak around and don't tell your firm. You have to tell your firm that, hey, I do have another job, and make sure your advice is unbiased. Okay. You may be a financial advisor and you may be a great realtor. Okay. But you have to be transparent both to your firm and to your client. Okay. Never lie. Never sneak around. And the last common type of conflict of interest is gifts and perks from clients. Are you allowed to get gifts from clients? Let's see that. So, receiving gifts or perks from clients might influence your decisions. For example, a client gives you an expensive gift, let's say a watch, $1,000 watch, to thank you for your service. Later, they ask for a risky investment and you feel pressure to agree because they were generous before. Okay. You may feel like, okay, you owe them because they gave you a gift. So this influenced your decision and how you treat your client. You need to avoid it. What's the solution? You need to follow your firm's rules on accepting gifts and never let gifts influence your financial advice. In most of financial firms, you are not allowed to get gifts more than X amount. That X is a little amount, like 300K, for example. $300, not 300K. $300. For example, a hat, a cheap hat, a $10 hat is fine in some financial institutions. Remember, each financial institution and each firm have their own policies and rules, and you need to follow your firm's rules about receiving gifts. But remember, all of firms and all of financial institutions do not allow you to get expensive gifts. Now, we covered different broad categorization of conflicts of interest. There were three. And then we talked about common types of conflicts of interest and solutions when you face them. But in general, you as a great mutual fund dealing representative, you have a general responsibility when you are facing conflicts of interest or when you feel that there is a conflict of interest when dealing with your client. What should you do and what you shouldn't do? Okay. You must identify existing and potential and perceived conflict of interest. Okay. You must identify the conflict of interest. Then you must report serious conflicts to your firm immediately. If you have, for example, another job, this was one of the common type of conflicts of interest. You must seriously and you must report your firm immediately, or other types of interest. Any serious one, actually all of your conflicts of interest, you must immediately report it to your firm. Then the third step is you need to fix conflicts in a way that protects the client's best interest. Okay? Always clients come first. You have to fix the conflicts of interest to the best interest of your client. And if you can't fix it, you need to avoid conflict, completely avoid it. And we will get to this fixing and avoiding soon, okay? Just bear with me. These were the steps that you need to take when you face conflicts of interest. But what are those things? What are the don'ts? What are those things that you shouldn't do? Okay. You cannot trade or give advice unless the conflict is properly handled and actually your firm has approved it. Okay. So before that, the conflict is properly handled and before your firm's approval, you cannot give any advice or execute any trade. Remember this. This is very important. Now, we talked about different aspects of conflicts of interest. It is time to get into the approaches of handling conflicts of interest. There are three broad approaches: avoidance, control, and disclosure. Okay. So, what's avoidance? Let's elaborate with an example. If a conflict is too serious and cannot be managed fairly, you must avoid it completely. Okay? Let's elaborate with an example. Let's say you work at a bank and you own shares in a company. Your client wants to invest in that company. Okay? That company is a small startup that you own, let's say, 40% of that startup. Okay? To avoid bias, you should not advise them on it. You cannot say to your client, hey, I own this 40% of shares of this small startup. You advise your client that, hey, invest your money in that startup's stock. You cannot do that. It's a biased advice. What should you do? You need to avoid it completely. How can you avoid? You say no to the deal. Okay, you stop selling that product or that service and you pass the client to someone else. These are three ways to avoid that conflict when happens. Okay, you say no to that deal, you stop selling that product, and you pass the client to someone else. The second approach of handling conflicts of interest is control. What does it mean? If you can't avoid a conflict of interest, you must control it by using clear policies and rules. Okay? Some conflicts of interest can't be avoided. What's the example? Let's say your company offers bonuses for selling certain products. This creates a conflict. We talked about it because you might push the product for money rather than what's best for the client. Okay. In these situations, you need to control the conflicts of interest. How do you control? You have clear rules to ensure fair advice. You train employees. I mean, your bank need to train employees on ethics. Your bank needs to use approval system before making recommendations. These are how to control the conflicts of interest. For those conflicts of interest that cannot be avoided. The third approach of handling conflicts of interest is disclosure. What's disclosure? If a conflict still exists, you must tell your client about it so they can make an informed decision. Okay. For example, you own a tax firm out of your firm, out of the bank. Okay. You have another job, which is a tax firm. And you refer your financial clients to your tax firm out of that bank. You must tell clients that you will profit from this referral. Be transparent and clear with your clients. So this is exactly disclosure approach. Okay. Let's say you work at a bank. Okay. And Mr. John is your old client. Mr. John trusts you. You are a good advisor. Okay. And you also have another tax firm, tax filling out firm outside the bank. Mr. John asks you that, hey, Nav, I want to file my tax and I need help. Do you know somebody who could help me here? Here you disclose that, hey, Mr. John, actually have another tax firm. I can help. But remember, I work here at the bank. You are my client. You're my customer. I need to disclose that. And I'm disclosing it to you. You need to decide if you want to work with me outside the bank or not. Okay. This is exactly what disclosing approach mean. So, what to disclose? Disclose? What to disclose? Explain the conflict in simple terms. Okay. You tell them how it might impact them. Give them time to decide. You cannot say to Mr. John that, hey, decide right now. You have 3 seconds. 3, 2, 1, go. No, just ask Mr. John, go home and think about it. If you find another tax firm, it's totally fine. Okay. Just give him a time to decide. Great. I'll see you in the next lecture. We said that obeying the law and complying with the law is super important. Let's say you are a financial advisor at the bank, and at the same time, you have a private corporation and do financial consultation. Do you think your current employer, bank, needs to know about your second occupation? Yes or no? Yes, the bank should know. If you don't tell your bank, this is one type of compliance issue. There is an issue with your act. Or let's say you have a client at your bank, Mr. Smith, okay? And you have a tax firm out there. You do taxes outside the bank, our operation. And Mr. Smith is looking for someone to file his tax. And you say that, hey, Mr. Smith, I do taxes too. we can set up a meeting after bank hours and meet, and I could file your tax. Is this legal? No, it's not legal. Mr. Smith is originally your bank's customer and you're not following laws. In this lecture, we are gonna know different and the most important compliance issues that you, as a future mutual fund dealing rep, you need to know about these issues so you won't do them. Okay, let's get it done. Compliance issues. What's compliance issue in simple terms? Remember when I said when you hear the word compliance, think of rules and regulations and ethics you need to follow as a mutual fund sales rep. Okay, compliance means following rules and ethics. Now, what's compliance issue? It means that a compliance issue is a situation where a person or a business, a firm, fails to follow rules, regulations, or ethical standards set by governing authorities. Okay, those CSA or the SROs and Provincial Securities Commission, they issue some rules. We as a mutual fund sales rep, we need to follow those rules. Also, our firm needs to follow those rules, okay? When a situation happens that we cannot follow those rules, this is exactly the compliance issue. I want to name all of the most common compliance issues in one scenario here. Let's say we have you and your old client, Mr. Smith. Okay, great. Now, in a scenario, I want to name all of the common compliance issues that might happen between you as a mutual fund sales rep and Mr. Smith. Let's go through the scenario. You have a long-time client, Mr. Smith, who's looking for investment advice. Okay. Outside of your bank job, you also run a private financial consulting business. This is when you see the first compliance issue, which is dual occupation. Okay. If you work at a bank, in a financial institution, and if you also have another occupation which is related to one you're doing at a bank, it's dual occupation. It's a compliance issue which is called dual application. Okay, let's continue our story, which isn't disclosed to your employer. Okay, we said that this is compliance issue and this is also conflicts of interest. Remember from previous lecture? So you need to disclose it to your client, of course, to your firm. You offer to Mr. Smith to personally manage Mr. Smith's investment through your private business. This is where the second compliance issue appears, which is control or authority over a client's account. You cannot control or have authority over a client's account. This is an issue, compliance issue. You're not following the rules here, okay? This is the second compliance issue. Let's continue our story. And even lend him money for a short-term investment. This is where the third compliance issue comes in, which is called personal financial dealing with clients. You cannot personally lend your client money or borrow money from your client. No, this is an issue. You're not following the rules. Okay, great. So far you work at a bank, you run another private financial consulting business. You offer to Mr. Smith that, hey, I can give you a private advice, and you're also willing to lend Mr. Smith money. So we've had three compliance issues so far. Let's continue. To encourage Mr. Smith to work with you, we're continuing, okay? Continuing from where that you are willing to lend him money. You're willing to lend him money to encourage him to work with you. You promise him lower fees in exchange for a personal referral to his business contacts. This is the fourth compliance issue, which is benefits to or from clients and referral arrangements. Okay. You're saying to Mr. Smith that, hey, I will give you discount, I will charge you lower fee, but I mean, you have a network, you have a friend, lots of wealthy friend. Can you give my card to your friend, or can I have their phone number? No, this you're benefiting from your client. This is an issue. Okay. Additionally, you're also licensed as a life insurance agent. This is another compliance issue, dual licensing as a life insurance agent. Okay, this is an issue. I mean, you can be, of course, you can be life insurance agent, but you need to disclose. Okay, this is different from dual occupation. We will get into details of these compliance issue in seconds, in minutes. Okay, just bear with me. I'm just describing the whole terms in one scenario for now, but we will get into details soon. So, you have a life insurance agent license and try to sell him an insurance policy without going through your bank's approval. When communicating with him, you send an email using your private consulting business name instead of your bank's official branding. This is exactly when the next compliance issue rises, which is trade names and business titles. When you work at a bank, you know Mr. Smith from your bank, through your bank. When you're emailing him, you cannot put your private company's trade information there. No, you should use your bank's information. So was another compliance issue. And you use misleading wording that guarantees high investment returns. In your email to Mr. Smith, this is the last compliance issue, which is sales communications. You're not being you're hiding something. Okay, you're guaranteeing Mr. Smith that, hey, if you invest your money in my private financial consulting or through my private financial consulting, I will guarantee you 30% return annually. No, this is a sales communication compliance issue. Now, let's get to details of each of these compliance issues. Starting off with personal financial dealing with clients. Let's get back to this scenario. Let's elaborate it with our scenario. Imagine Mr. Smith needs quick cash for an investment. You decide to lend him money or borrow from him. While this might seem like a friendly favor, it's not allowed because it creates a conflict of interest. This is exactly an example of personal financial dealing with client. So what are other examples of dealing with client? Lending money, we talked about it. Borrowing money also, you're not allowed to borrow money. Buying assets from a client outside your job. Okay, you cannot, let's say, purchase your client's house or car. No, this is not allowed. You're not allowed. Or joining private investment clubs with clients. You cannot invest together. No, this is not allowed. Okay, these are examples of personal financial dealing with clients. And why is this type of compliance issue important? Because it can lead to biased advice or favoritism and a financial risks that might harm the client at the end of the day. Great. Let's get to this second compliance issue, which we talked in our scenario: control or authority over a client's account. Let's get back to our scenario. We said that Mr. Smith asks you to manage his account because he trusts you. He even gives you power of attorney or POA to handle his investments. This is not allowed. No, you cannot accept POA from your client. What are other examples of control or authority over the client's account? Uh, Acting as a power of attorney. We talked about it. You cannot act as a power of attorney for a client. Becoming a trustee or executor for their estate, for your client's estate. You cannot become a trustee or executor. And making investment decisions without client approval. No. Although Mr. Smith trusts you that you are a good advisor, you cannot make an investment decision without Mr. Smith's approval. Okay, these are example of this type of compliance issue. Why is this a problem? Because it gives you as a mutual fund sales rep too much control and power, which could lead to conflicts of interest or financial abuse. Okay, if Mr. Smith gives you an authority to do whatever you want, you might transfer some of Mr. Smith's money to your account. I mean, you won't do that, obviously. I mean, everything is being tracked, and you are a good guy, um, and you won't do that. I'm sure about it. But it's temptation, so we need to avoid it. Let's get to third type of compliance issue, which we covered in our scenario, which is benefits to or from clients. We said that if Mr. Smith is happy with your service and offers you a free vacation stay at his Florida condo, for example, and you accept the offer without informing your bank, this is a violation. And even if you inform the bank, you cannot accept that offer. I mean, who hates a free vacation stay in Florida, a free one? I mean, everybody loves it, but you need to avoid it because it's a compliance issue. You're not following the rule here. What are other examples? Gifts of a small value like a coffee are okay. Okay. If your client buys you a coffee, you don't need to report it to your firm. It's okay. I mean, coffee is $3, but expensive gifts like a condo stay, it's not okay. And referral fees also must go through your firm. Okay. Why is this a problem? Why is this compliance issue a problem? Because it could influence your advice and create unfair advantages for certain clients. If Mr. Smith offer you free vacation stay, you may charge you would be nice and treat Mr. Smith well, and you would for example, if Mr. Smith later on wants a loan, you won't review his documents like thoroughly, and you would be like, okay, this is Mr. Smith, I know him, I'm gonna approve it. You're acting with a bias now. You are giving unfair advantage to Mr. Smith, which is not allowed. The fourth compliance issue is dual occupation and outside activities. We said that let's say beside your bank job, you also work as a mortgage agent and a real estate agent. That's fine. You can do it, of course, but you must inform your employer. Okay. What are the examples? Working in insurance, real estate, tax services, or mortgage broker. These are examples of dual occupation or outside activities, or being a board member or volunteer in a community organization. This is another example. Or holding a leadership role, for example, a military officer. Okay. These are if you are a military officer outside your bank, you have to report it to your bank because it's a leadership role. You may influence those who are working under you, okay, those who are following you. Why is this a problem? Because your outside work could conflict with your financial advice, leading to bias or unethical recommendations. Let's get to referral arrangements. What was the scenario? Let's say Mr. Smith refers his business contacts to you in exchange for lower fees on his investments. You cannot do this unless it's approved by your firm, which your firm won't do it because it's unfair to other clients. But about referral arrangements, there are some certain rules that you need to be aware and you need to follow. What are those rules? All referral fees must go through your firm, okay? And the registered firm must be a party to the referral agreement. For example, if you're referring your client to a tax firm outside your job, there should be a contract there that your firm that you're working right now needs to be one party to that contract, and the other tax firm should be another party, okay? So uh, this is exactly what does this line and statement mean. The second rule is you cannot pay or accept money for referrals without disclosure. We said that disclosing to the client and firm is the key thing. Third rule, the KYP obligations apply to referral arrangements, and registered firms are required to conduct due diligence to determine whether referral arrangements should be approved by the firm or not. What does this mean exactly? Let's say you are referring product X to Mr. Smith outside of your bank, okay? Before referring that product X, you have your Mr. Smith file, KYC file in your system, okay? But you don't know about that product. You should make sure that product that you're referring matches with the profile of Mr. Smith, okay? You need to know your product that you are offering, KYP. You need to know that product, and you need to do due diligence, like investigate and research about that product before referring it to Mr. Smith. Let's get to another rule. If you refer a client to another investment company, like an investment dealer or portfolio manager or exempt market dealer, there are strict rules on what you cannot do. You cannot fill out account forms or KYC documents for that another company. What does this mean? Let's say Mr. Smith is interested in a specific product that your firm or service that your firm, your bank does not offer that. But you know a firm or your bank knows an investment dealer that offer that product or service. Okay. And you want to refer Mr. Smith to that firm. That firm, that third party firm, may ask you or your bank that, hey, you have Mr. Smith KYC. Can you send that to us? Or can you do me a favor and fill out the Mr. Smith KYC for me? Because it's your client and you know Mr. Smith. No, you cannot do that. You cannot fill account forms or KYC documents for that other third party company. You cannot sit in on meetings where the client is getting investment advice for their accounts at that company, okay? If let's say Mr. Smith trusts you and say, hey, Nav, can you come with me to that third party company? Because I trust you. I want to make sure that um, I'm not doing a bad thing and they are offering a good thing to me. Could you please come? No, you cannot sit there. You cannot be in that meeting. It's not allowed, okay? It's an issue. And you cannot look at or access the client's account details or trades from that company. But why is this referral arrangement rules is a problem? Because these rules are not a problem. I mean, not following referral arrangement rules is a problem because it creates a conflict of interest and could lead to biased advice like other compliance issues. Great. Let's get to the next common compliance issue, which is sales communication. What does it mean? Let's elaborate with our scenario. You promise Mr. Smith guaranteed high returns on his investment. This is misleading and illegal. You cannot do that. I told you. Okay. What's your rule here as a mutual fund sales rep? You should never guarantee investment returns. Never. But what can you do? You can provide info about funds features, fees, and risks, for example. Okay. You can provide quotations, rate of return, yield, volatility, or any other measurement of performance. You can do that about past for that rate of return. I mean about the past performance, okay? And quotations, you can do that. You need to avoid misleading or exaggerated claims. And all advertising and sales communications, including websites, must be approved by your dealer before you can publish or issue the communication, and always use your firm's official branding in communication. First of all, if you want to email something, a template, for example, to a bunch of clients, you need to get your firm's approval, okay? Because you are contacting your clients on behalf of your firm. Your firm's branding is in that email, okay? They need to approve it first. After their approval, in the content of your email, you cannot say, hey, clients, dear clients, breaking news, 30% return guaranteed. No, you're not allowed to do that. You can share some information about the product, for example, previous returns or risks, fees, hidden fees, features, pros and cons about that product, but guaranteeing or exaggerating on something is not allowed. And why is this a problem? Because false promises can mislead clients and damage trust. Last but not least, compliance issue, trade names and business titles. What was our scenario? Let's say instead of using your bank's official email, you send Mr. Smith an email using your private business name. This is not allowed. What are rules when we face and deal with this compliance issue? You need to always use your firm's official branding. You do not misrepresent your rule. Okay? All dealing representatives like you are governed by the holding out rule. What does it mean? It means that as a dealing representative, you must not present yourself in a way that could trick or mislead clients. Okay? What does it mean exactly? Let's dive deeper. For example, you cannot use a job title that makes you seem more qualified than you are. You cannot say you are a portfolio manager with just CIFC or IFC or CSC certification. No, you're a mutual fund dealing representative, which is a good title. You cannot mislead clients because portfolio managers typically have like 20 years experience. Okay, when you use this title, you're misleading your client, and this is not allowed. The other things is claiming to offer services you are not allowed to provide. You are a mutual fund sales rep. You cannot say that, hey, you can buy insurance from me. No, you can't sell insurance because you're licensed in a different industry. Okay, and You cannot give the impression that you work for a different company or have a special approvals that you don't actually have. All mutual dealing representatives are same. Okay, you don't access to special products or special uh, bonuses or special discounts that other mutual dealing representatives do not have access. You cannot imply in this way. Okay, you cannot say I'm a special advisor in my bank. Okay, other advisors are bad, just avoid them, just come with me because I know the tricks, I know the discounts, and I know the manager. He will give me discount on your mortgage rate. No, this it doesn't work like that. These You need to follow these rules when dealing with trade names and business titles. And why is this compliance issue a problem? Because clients need clarity and transparency about who they are dealing with. They need to know you, but they need to know the honest version of you, okay? You cannot lie to them. Great. This was a very, very long lecture, and I'm really sorry about it, but we had to cover it. And I'm sure that you now understand, fully understand all the compliance issues and what should you do, what's your role. And I'm a little bit relieved. But what are the key takeaways here from this lecture? Let's summarize them. Number one, keep financial dealings with clients professional. Okay, no personal loans, borrowings, or joint investment. Second takeaway, never accept benefits of significant value from clients without your firm approval. Your firm even won't approve significant value gifts. I mean, coffee is okay, but free vacation in Florida is not okay. Third takeaway, disclose all outside business activities to your employer. Okay, you cannot hide that you are a realtor or mortgage agent or insurance agent. No, ensure referral arrangements are firm and approved. Another takeaway, communicate honestly and use official firm branding, not your private corporation's title. And last but not least, do not take control over a client's account. No power of attorney or POA. You cannot be trustee or executor of the states of your client. Nope, you cannot do that. Great. Thank you very, very much for finishing up another lecture. And don't worry, you will see the type of questions you may get from compliance issues. And actually, it is a very important quiz. So please go crash it for me. I'll see you in the next lecture. The compliance issues we covered in the previous lecture have some brother called prohibited practices. What do I mean by that? Let's say you do have a long-term client, and that client, let's say that client is Nav, okay? Nav trusts you, and Nav is an old man, trusts you, and he want to go on a vacation. He tells you, "Hey, X, just when I'm not available, you can sign on behalf of me. You can do trades, buy and sell. You can actually, I can sign some papers, some blank papers. So if you need my signature, you can just copy and paste." What would you do then? Would you accept and say, okay, this client trusts me, so I think it's legal because that client needed me to do that? No, these are types of prohibited practices. In this lecture, we're gonna dive deeper and know some, I think, eight of the most important prohibited practices, like falsifying, like misleading clients, and other important prohibited practices. Let's get it done. Prohibited practices. Okay, what's prohibited practices in simple terms? Prohibited practices are actions that are not allowed under mutual fund dealer rules or MFDA rules of zero. Okay. Why? Because they can harm clients or create conflicts of interest. Of course, we covered compliance issues. Also, those compliance issues were things and activities that we shouldn't do as a mutual fund sales rep. Here, prohibited practices, of course, have some overlapping with the compliance issues and things that we shouldn't do, but we are doing it from another perspective. These are the things that you shouldn't do towards your client. Just like the compliance issues that we covered in previous lecture, let's elaborate prohibited practices with an example and scenario, okay? And then dive into details of each of them. For this scenario, we have you as a mutual fund dealing representative, and this time instead of Mr. Smith, we have Mr. Johnson, okay? Um, Mr. Johnson is your client, okay? You work at a bank and Mr. Johnson is your client. Now, let's know different prohibited practices with this scenario, okay? To make things easier for Mr. Johnson, you convince him to grant you power of attorney. We had this in compliance issue, remember? Power of attorney, giving a power of attorney is a prohibited practices, okay? This is under control or authority prohibited practices. Mr. Johnson cannot give you POA, okay? Over his investment accounts. Over time, you start making trades on his behalf without consulting him. This is called discretionary trading. Discretionary trading is another prohibited practices when your client doesn't know that you're trading, okay? Discretionary trading, including frequently buying and selling of funds to generate commission. This is called excessive trading and churning. This is another prohibited practices. Just for the purpose of more commission, you cannot trade more and actively trade, buy and sell to get more commission. To exhibit transactions, you have him signed multiple blank trade forms in advance. This is called pre-signed forms, which is another prohibited practice. Okay. On occasion, forge his signature when he's unavailable. So this is another prohibited practices of signature falsification, which you need to avoid. Then you also recommend and execute trades in securities that you are not licensed to sell. This is unregistered trading prohibited practice. And sometimes you let colleague handles trade using your code. This is called stealth advising. It's not allowed. Stealth advisings happen when your colleague handles trade using your credentials. Okay. Finally, when Mr. Johnson expresses concern about the cash flow, you offer him a personal loan from your own funds, which is personal financial dealings. We had that as a compliance issue. It is also a prohibited practices. So these are the most common prohibited practices that you shouldn't do to your client. There are some overlaps with compliance issue, which is understandable. Now, let's categorize each of these prohibited practices under 3 groups. Group number 1, prohibited practices concerning trade authorization, POA, signature falsification, pre-signed forms, and discretionary traded falls under this group. Second group is prohibited trading practice. So, unregistered trading, stealth advising, and excessive trading and churning falls under this group. And last group is prohibited practices of personal financial dealings, which personal financial dealings falls under this group. Now, let's dive into details of each of these prohibited practices, just like the thing we did with the compliance issue. Number one is trade authorization rules. What was the scenario? Mr. Johnson trusts you so much that he says, just make the trade for me. I don't want to deal with the details. Okay? This is wrong move. Okay? What are the rules that I apply here? What are the MFTA rules? You cannot have power of attorney, which means you cannot manage his account for him. You cannot be his trustee or executor. You cannot make financial decisions on his behalf. We had it in the compliance issue. This is overlapping, okay? Same thing, but under different topic. Here, it's under MFTA rules and prohibited practices. You cannot have the discretionary trading. It means you cannot buy, sell investor for him without his approval each time, okay? You have to get approval each time. You cannot have pre-signed forms. You can't ask him to sign blank forms in advance for future trades. No, you cannot do that. You cannot falsify his signature. You cannot sign for him if he told you it's okay. It's not okay. It's a wrong move. But there is exception in this type of prohibited practices. What's that exception? If Mr. Johnson was your spouse, parent, or child, so no brother, sister, and no or uncle, no siblings, okay? Just spouse, parent, and child, then only with written approval from your firm, you might be able to act as power of attorney. This is the exception. Very, very important exception, by the way. You may get questioned from this exception on your final test, okay? So if Mr. Johnson is your spouse, parent, and child, you may have power of attorney and it's okay. Even not siblings, okay? Get to the second type of prohibited practices, which is signature falsification. What was the scenario? Mr. Johnson is going on vacation and says, just sign the forms for me when I'm away. Nope, you cannot do that. That's illegal. What are the rules here? Signature falsification includes signing for a client even with their permission, okay? You cannot, under any circumstances, you cannot sign on behalf of your client. This is signature falsification, even if your client permits you to do that, okay? Having them sign blank forms for future trades. This is another example of signature falsification. Cutting and pasting, copying and pasting their signature onto another form. This is illegal action. You cannot do that, okay? Or making change to a signed document without them initiating it. But why this signature falsification is very, very serious? Because it gives you too much control, which could lead to conflicts of interest or financial abuse. Let's get to the third prohibited practice, which is unregistered trading. What does this mean? Let's elaborate with our scenario. Let's say Mr. Johnson asks you, can you invest in some stocks for me too? What are the rules here if this happens to you as a mutual fund sales rep? You cannot do that. Why? Because you are a mutual fund dealing representative. You are not licensed to trade stocks or options, for example. No, you only can sell mutual funds. Only properly registered advisors can trade in a specific investments. If you trade outside your license, you're breaking securities law. Think of it like driving without a license. Just because you know how to drive doesn't mean you can legally operate or drive, okay? So this was a good analogy. Next prohibited practice is Stealth advising. This is a very important one, and there's a high chance that you may get question from this prohibited practice. What's stealth advising? Let's get to our original scenario. Let's say your colleague, Brian, isn't licensed to sell mutual funds, but he asks, hey, can I use your rep code to place some trades for my clients? Or let's say he is licensed, okay? And you're too lazy to handle your client. You say to Brian, hey, Brian, could you please do these trades with my credential, using my credential? No, this is stealth advising, and you cannot do that. What's the rule here? It's a no way, okay? This is called stealth advising, and it's a serious violation of rules and laws of MFDA. You cannot do that. What happens if you do? If you let someone else use your credentials, you're both guilty of fraud and unregistered trading, and you will die. No, just kidding. You won't be die. But I mean, your license will be suspended probably, and you'll get fired from the bank, and etc. So don't do that, please. So no giving your credentials to your friend or colleague. Number 5 of prohibited practice is excessive trading and churning. What does it mean? Let's get back to our original scenario. Let's say Mr. Johnson has a big portfolio, and you realize that if you buy and sell frequently, you'll earn more commission. Woohoo! Let's do that. Let's buy and sell more frequently because Mr. Johnson has 10 million in portfolio. He won't notice it. No, this is illegal. You cannot do that. What are the rules here? That's called churning. So buying and selling to earn commission without a good reasoning is called churning. This is also very important. You might get a question from this churning, okay? So listen carefully here. What are the signs of excessive trading? Frequently buying and selling, of course, rings a bell. Trades that don't align with the client's best interests rings a bell. High commission charges rings a bell. These are all examples of excessive trading and churning. What's your duty when you are in this condition and situation? Your duty is to act in Mr. Johnson's best interest and not just to make money from commission. The 6th prohibited practice is personal financial dealings. We had this in the compliance issue, but let's recap again. Let's get back to our original scenario. Let's say Mr. Johnson runs into financial trouble and asks, can you lend me some money until my investment grow? What's the rules here? What's the MFDA rules? It's a no. It's a big mistake. You cannot lend money to clients. You cannot borrow money from clients. You cannot co-sign a loan for them. You cannot do that. Okay? Why? Why you cannot do that? Why you cannot be a nice person and help your client? Because it creates conflicts of interest and can lead to unethical behavior. In the context of prohibited practices, there is a very important form. When you hopefully work at a bank, you will hear about this form a lot. This is called Limited Authorization Form, or LAF, or laugh. Not that laugh, haha, that's, I don't mean that, but LAF. What's this? Let's get back to our scenario. Let's say Mr. Johnson is traveling and tells you, just place trades for me while I'm gone. Okay? What should be your answer? Your answer would be, hey, Mr. Johnson, a limited authorization form, or LAF, might help in this scenario. So, what is LAF? LAF, or limited authorization form, lets you, as a mutual fund sales rep, place trades on his behalf, on Mr. Johnson or your client's behalf, but still needs his authorization. LAF saves time by not requiring Mr. Johnson or your client's physical signature every time. Okay, if he's going on a trip, it's fine, and it's a good way to use LAF. We talked about what LAF does, but what LAF does not do. That's another important aspect of LAF, or limited authorization form. It does not give you discretionary trading power. Okay, you cannot just buy and sell without letting Mr. Johnson or your client know. It doesn't give you that power. And you must still get your client's approval before making any trades. But what happens if you break these prohibited practices rules, these important MFDA rules? If you engage in prohibited practices, you could face investigation, suspension, losing your license, lawsuits, and financial penalties. There is a bottom line. Always act in your client's best interest. Follow the rules and never, ever cut corners. Great. You might think what type of question I might get from this long lecture. Don't worry, just take the next quiz. You are doing great. I'll see you in the next lecture. In this lecture, we're going to talk about three terms: NRD, the client mobility exemption, and passport system. What are these? NRD is all about your registration process. So when you pass CIFC, IFC, or CSC, you need to get registered to be an official mutual fund dealing rep. NRD is a platform that your bank fills out forms and inserts your information into that platform. The client mobility exemption is all about the times that you, for example, you live in Ontario, you have a client in Ontario, but that client wants to move to, let's say, British Columbia. But that client still wants you as his mutual fund billing rep or financial advisor. Can you still continue servicing that client? You're in Ontario, she or he will be in British Columbia. We're going to answer to this question, so stay tuned. And passport system is all about, let's say you're registered in Ontario, but you want to be registered in Calgary. Can you just go there and practice? We're going to answer to that question too. So let's get it done. Registration. Okay, what's registration? To legally sell investments and mutual funds, you must be registered with the securities regulators. We know that. We covered these concepts in previous lectures and chapter. Your firm will get registered first. So your firm need to be registered first, and then they will sponsor your registration. And we know that until your registration is approved, you cannot offer investment funds or mutual funds or any other products, investment products, to your clients. In this lecture, we're going to cover the process of being registered and being able to sell as a registered and official dealing representative, mutual fund dealing representative. And also, we're going to know some terms like NRD and client mobility exemption and the passport system in this lecture. So part of this lecture has been covered before. I know, just you need to bear with me, please. But new concepts are covered also in this lecture. Let's say you passed CIFC or IFC and CSC, and hopefully you get a job at a bank. Okay, you started working at a bank in Ontario. Let's say the province is Ontario. First things first, before you can officially become a dealing representative, you need to do certain things. We know that you need to pass a recognized exam like Canadian Investment Funds course or IFC or CSC.
And secondly, you need to find a firm like a bank that will sponsor you. So the firm that or the bank sponsors you. You cannot just go and individually register with the securities regulator. No, it doesn't work like that. And then when the bank registers you, sponsors you, you need to complete the RCMP criminal record check. You need to have a clean criminal record, and then you need to fill out a form called 33. It's not that important for. It's a form, okay? You need to fill out. You don't need to remember what type of form. You need to fill out that form. It's an official registration application form. And lastly, you need to provide documents about any other jobs or business activities that you had. This is the whole process. Uh, let's get to the concept called National Registration Database, or NRD. Let's say you fill out the form and your documents are ready. Okay. Now, your firm or the bank that you hired you reviews the documents and the form and submits them through the National Registration Database, or NRD. So the bank submit your details, your registration form into the NRD. Okay. Now, the NRD is an online system where all registration applications are submitted. Your firm's authorized firm representative, or AFR, will handle this for you. Okay? So, your firm will register you through NRD. That's simple. Now, if you need to register in multiple provinces, one application through NRD covers them all. You don't need to, let's say you want to register in British Columbia or in Newfoundland, okay? You don't have to have multiple application because NRD applies for all Canada. It doesn't mean that if you registered in Ontario, you can practice in British Columbia too. No, you have to submit an application in British Columbia, but it is way easier because your information is in RD, but you still need to go through the application process for British Columbia. Now, let's say your firm has submitted your documents in form through NRD. What's next? It's waiting period. What does it mean? It means your application, the securities regulator is reviewing your application. Now, your application is in the hands of the securities regulators of the province or provinces where you applied, okay? What do they do? What do the securities regulator do? They will check your background. Are you clean or you're a wanted person? You have to be clean. They will confirm you meet the requirements. Did you pass IFC or not? Did you pass CIFC or CSC? They need to confirm you meet the requirements, and they need to approve or deny your registration after a while, after a couple of weeks. Okay. And during this waiting period, you must wait until you get approved before you start selling. You cannot sell mutual funds during this waiting period. Now, let's say the securities regulator confirms you and approves you. Congratulations, you are now officially mutual fund dealing representative, but there is a training that you have to pass. What does that mean? Once you approve, your firm will put you through first 90 days training program. And remember, it applies to all banks and financial institutions, okay? Not just specific banks. Then 6 months supervision. Once your trading is done, now you can start selling mutual funds, but under supervision. Okay, your trades and accounts need pre-approval. If you're recommending a mutual fund to a client, like in this period, you have to get approval from your manager, okay? But after this, when the first 90 days and then 6 months is done, you're officially a dealing representative. Woohoo! Congratulations. And I'm sure you're going to be a great one, by the way. Now, we covered NRD, then waiting period, and then training that you need to pass. Let's get to three important concepts in the for after registration. Number one is client mobility exemption. What does it mean? One question. I do have one question from you. What happens if your client moves to another province? What do I mean by that? For example, you have been handling Erica's portfolio for 5 years in Ontario. Okay. Now, she gets married and then she moves to BC. But Erica wants you to continue handling her investment. But you aren't registered in BC, so what happens? What happens to this client advisor relationship? Because Erica trusts you and she wants you to handle her investments. This is where the client mobility exemption comes in and allows you to continue working with Erica without registering in BC. That's the important part. You don't need to register in BC, okay? But there's a point here. You can't take a new client there. You can just handle Erica, okay? For example, Erica asks you, hey, can you handle my husband's investment also? You cannot handle that. No, Erica was your client for 5 years. And this client exemption mobility or mobility exemption only applies to Erica, not new clients in BC, okay? Now, to use this exemption, there are some conditions here. Your firm must be registered in the new province, which is obvious. Like we have banks in all provinces, so no worries there. Okay. Also, you can have a maximum of 5 clients in that province. So this exemption, client mobility exemption, only applies to 5 clients, maximum of 5 clients. Okay. Keep that in mind. And lastly, that last condition, your firm must disclose to the client that you are exempt from registering there. These are the conditions. Great. Now, let's get to passport system. What's passport system? That's a weird term. No, it's not weird. We're going to learn it now. So, if you need to register in multiple provinces, the passport system makes it easier. Let's elaborate. Instead of applying to each province separately, you apply once to a principal regulator. What's principal regulator? It's usually where you work. Okay, so if you work in Ontario, for example, your principal regulator will be Ontario. So you apply to your principal regulator, which is Ontario Commission. Okay. Now, the other provinces follow the principal regulator's decision. Okay. For example, you works for ABC Investment in, let's say, Vancouver. Okay. Not Ontario, Vancouver. Now, your firm's head office is in Alberta. But since you work in BC, your registration is processed by BC Securities Commission. Okay. And passport system applies here. And if you want to register in Alberta, you can register there easily without opening up and going through all the processes. Okay. But there is an exception here. Ontario is not fully part of the passport system. So if you apply for Ontario, it may do its own separate review. Okay, so passport system eliminate the need for review all the documents over again. If you are already registered in BC, for example, and you want to register in Alberta, okay? Since Alberta and BC both are part of passport system, and since the BC has already reviewed your documents and information, now you don't need to go through all their reviews. Alberta just see what BC decided and says, okay, since BC decided and approved your application, I'm going to approve yours too. So no problem, come and be registered here. But this is very important point that Ontario is not part of passport system. And last point about this whole pre or post registration points is if anything important changes, for example, you got a new job or new business or some legal issues happens to you, okay? Any information, any change of information, you must update your NRD file. Keeping it accurate is your responsibility. So anything important happens, you have to keep your NRD updated. Great. What a lecture. And please go take the quiz because we have some questions about passport system, NRD, and client mobility exemption. If you're wondering what type of question you may get on your final test from these important terms, you're doing great. I'll see you in the next lecture.